Hello and welcome to this free webinar from Accounting CPD. My name is Alan Nelson. I'm the founder and managing director of Accounting CPD. What you're about to see is a recording of one of our recent webinars. It's one that's from our Lunch and Learn series, a webinar that we run on a monthly basis specifically for people in practice. We focus on news stories and recent updates that we think will be useful. Our license holders get to see these webinars live and they can comment and ask questions. And they also get to see all of our other resources, ranging from 15-minute CPD bites right through to extended 21-hour career progression pathways. If you watch the webinar and you want to record it as a piece of CPD, then click on the link in the description below and you can register for an account on Accounting CPD and you can add this webinar to your CPD log as a piece of external CPD. If you have questions as we go along, post them in the description below and we'll endeavour to answer them. It just remains for me to say thank you for watching. I hope you find the webinar interesting, useful and valuable. Hello and welcome. My name's Alan Nelson. I'm the founder and managing director of Accounting CPD. I should start by welcoming all of you attending today. Thank you for joining us. I hope you find the next hour interesting, relevant and useful. This month, we're taking a look at what's coming up in the year ahead. Our first guest is ICAEW past president Julia Penny, who'll be giving us an overview of some of the key things we should be looking out for. And then we have Steve Collings, who'll be zooming in a little on the periodic review. And finally, we'll be talking to Accounting CPD's Rachel Bruce, who'll be sharing some insights we've gleaned from you over the past month. As we go along, please do ask questions. The Q&A session at the end is often the most interesting part of the webinar, but it only works if you ask those questions. Along the way, you can also contribute by using the chat facility, and I'll try and pick that up as we go. So, without further ado, I'm delighted to welcome our first guest, Julia Penny. Julia Penny is a past president of ICAEW, having been a non-executive ICAEW board member since 2017 and chair of the board during her year as president. Julia is also a member of the ICAEW Council and a past chair of both the ICAEW Technical Advisory and Ethics Advisory Committees, a former member of the Technical Strategy and Financial Reporting Faculty Boards and of the AAT's Council and Audit Committee. Outside of this volunteer ICAEW involvement, Julia is a well-known speaker and writer on audit, financial reporting, anti-money laundering and wider issues impacting the profession. She's the author of AI and Ethics, published by Accounting CPD, and is promising this year to write 2 new courses, one on leadership and the other in the profession and the other on mid-tier firms. So I should get this webinar over and stop distracting her so she can get back to it. Hello, Julia.
Hello, Alan, and thank you very much. I do wonder, yes, when you list off all these committees, where I found time for the day job. And I was writing the course earlier before we started this.
Oh, well, that's great to hear. Okay, well, let's dive straight in. I know that one of the things you want to talk about, and I'll start with, is the Economic Crime and Corporate Transparency Act. I think there are some new requirements coming into force. Is that right?
Absolutely. The gift that keeps on giving. You'll have been hearing about ECTA, if you want to shorten it to that, or ECCTA, or in full, the Economic Crime and Corporate Transparency Act for quite a long time now, because it came into being in 2023 and we're now in 2025, but a lot of it is quite long lead-in times. One of the key things that we've been thinking about is the identity verification requirements. So everybody who's important, if you like, on Companies House, so directors, members of LLPs, anybody submitting information to Companies House, they will all need to have their identity verified. And this is now getting really close. We've been talking about it for ages. It's now getting really close. From March this year, so very, very close now, individuals will be able to voluntarily verify their identity using the new sort of Gov tool to enable you to do that. And then we're expecting that sort of by the autumn, it will start to become mandatory. Essentially, I think they're going to use the voluntary IDV short for identity verification, to check that it's all working properly before they say, yeah, everybody's actually got to do it. So that IDV is something that individuals can do themselves, But firms will remember that there's the capacity for them to offer that service once they are registered as an authorised corporate service provider, or ACSP. Lots of acronyms in that. Now, we didn't quite know when that was going to kick in, but we've now seen from February, so literally just around the corner, firms will be able to start registering as ACSPs. That will give them the ability to file things for their clients, i.e. what they can do anyway at the moment, but it will also, if they choose, give them the ability to provide an identity verification service for their clients. Lots of things to think about there, not straightforward. Of course, there's a fee to register, and it's £55. Everybody loves to know that when they're an accountant, don't they? How much it costs. So yeah, lots on the IDV side of it.
Yeah, absolutely. And I can't emphasize enough how important this whole area is, having been involved for many years with ICAEW's Practice Assurance Committee. I think perhaps the major cause of cases ending up in front of the committee, and I should say ending up in front of the committee is quite a hard thing to do. You have to not do things correctly, and then you have to steadfastly refuse to put it right, and rant quite a lot about political correctness gone mad and how it's all a complete conspiracy. And then you end up in front of the committee, and they don't take a very positive view of it, because you would have taken less time to put the thing in place than it would have been to argue the toss backwards and forwards. But it is. I mean, I know it's an irritation to everybody, but it's quicker to just get on with it. I've got a question that's popped up in the chat from Andre. What will happen to companies that are already registered but without someone's ID verified?
They will have to register. So we don't know all of the details of the timing, because there'll be a transitionary period for those that are already on Companies House. Obviously, as Andre sort of implies in the question, if you're wanting to go on the first time, so you're becoming a director for the first time, you will have to verify your identity before you get permission to go on, if you like. But for existing ones, there'll be a transitionary period. It might be up to a year, so it might coincide perhaps with the confirmation statement deadlines, and yeah, you've got to be registered by your next confirmation statement. So still a little bit more detail needed to come out before it mandatorily takes effect. We're expecting it to be autumn in terms of when it will kick off. But as I say, the transitionary period, we don't quite know how long it will be, but we're expecting one.
Okay, I think sticking with the ECCTA, is there a requirement on larger companies and partnerships and slightly more serious impact if they fail to prevent fraud?
Yes, so we've seen a number of things coming out, like we've had laws on making sure that you have reasonable procedures to prevent sort of tax fraud. I summarise, but that's the gist of it. But what this is a failure to prevent fraud for large organisations. So the original requirements were large in terms of small, medium, large company requirements. However, more of that in a second, but those limits will be changing. But as it stands, these limits will still be the current limits. So more than 250 employees, more than 36 million turnover, more than 18 million total assets. And it applies to more or less any type of organisation. So it might be a company, a royal charter, or whatever, if it's big. And what those companies, organisations, whatever, will need to have in place is reasonable procedures to prevent fraud which might be committed by associated persons which could benefit the organisation. Now that sounds all a bit like, what? How many sort of ifs and buts and whatever? But essentially, associated persons would cover certainly all employees, but also people who are providing a service for you. So if you get a freelancer to do something for you, or you have agents or whatever doing something for you, they would be associated persons. And you have to have in place reasonable procedures to make sure that they don't think it's a good idea to commit fraud. Simple example given in some of the guidance which we've now got is a salesman mis-selling. So they're selling stuff to people who they shouldn't be selling it to, or whatever, but because they might get a bonus, but also, of course, the company will get an extra sale if that happens. So that sort of thing, if they're mis-selling and it would meet the definition of fraud, which it might in a number of cases, then that would be something that the company could be held accountable to. Now, in the past, you've only been able to pin things on sort of high-level company management if the management knew what was going on specifically, which worked with small companies. Usually you could get small companies, say, well, the manager obviously knew about that, but big companies, not a chance. So now it says, no, the company itself, therefore the leadership, has this responsibility to try and limit, to put in place reasonable, risk proportionate procedures to prevent fraud. So that's something that big companies will have to think about. Accountants will have to think about if they're advising big companies. To be honest, it's not a bad thing for smaller companies to think about if they've got enough of an infrastructure, where things could go on that they don't know about. But certainly it'll be a requirement for big companies. We've just touched on it.
That's mirroring some things that have happened in adjacent areas. Looking back to my old world of educational book publishing, there was a time before the Bribery and Corruption Act where people sold school books in parts of the world where bribery was endemic, and what they did was they employed an agent in the local territory and said, the deal here is that you get X% commission on anything you sell. And it was clearly unspoken but agreed that if there were any backhanders that needed to be given, the agent would give those and it would come out of their commission, and the UK company didn't need to know anything about that. And this is a massive shortening of the story, but a new American chief executive came into Macmillan School Book Publishing and found that this was going on, and it clearly thought, I'm not having this on my watch, and self-reported, and the entire sector got crawled all over, and everybody had unpleasant stuff attached to them by the end of it. And none of that happens anymore as a result. But it's been a massive change, and a good one for the better as well.
Yeah, absolutely. As you say, that bribery and corruption bit we've had for quite a long time. This works in a similar sort of way. It'll kick in from the 1st of September 25. So companies have got a little bit of time to prepare to get their procedures up and going. But they should be able to embed it with, their anti-corruption, their tax evasion sort of prevention policies, because it's the same sort of thing. The guidance which is there sort of talks about the same types of thing. It does need commitment from the very top level. So, and what you're highlighting there is, it is ultimately the top level that can say, hang on a minute, don't do this. And that's what is needed as the starting point for this.
Yeah, good. Okay. I think there are also changes coming down the line on thresholds to company sizes for reporting requirements.
Yes, so we weren't quite sure what was going to happen about this, because the Conservative government said, hey, we're going to increase the monetary thresholds, not the number of employees, but the monetary thresholds for small and medium, large companies by sort of about half again. And then it went a bit quiet with the new government taking over. We've now had confirmation they are going to keep with those proposed new limits. So they will kick in rather oddly from the 6th of April this year. So essentially, small company limits, micro company limits go up by 50%, small company limits go up by 50%. So we've got quite a big change there. And of course, remember that it's small companies that are exempt from audit. So you're going to have a whole new raft of companies that will become exempt from audit, supposing that they meet all the other criteria that there is, because the limits will have gone up. So lots for firms to think about, both in terms of the nature of the accounts that they're preparing and the audit implications of these limit changes.
I have an image in my head of lots of finance departments in small businesses doing a little jig now.
Well, yes, I mean, certainly, I think a lot of people will be happy, and even auditors and accountants who might be thinking, well, I'm going to lose that audit because it won't need an audit, probably will also be quite happy, because there's so much pressure in the audit ecosystem at the moment in terms of not quite having enough staff to do the work that you've got. By taking out a whole load of extra companies from the audit requirement, actually that might allow the audits that are still going on to be better managed, better staffed, because you haven't got that pressure of audits that maybe weren't really achieving a great deal from the viewpoint, at least, of those smaller companies. We say smaller, they're getting bigger and bigger. Audit exemption started off at a tiny weeny limit, and now we're going to be talking about sort of 15 million turnover. So, big changes, big changes.
Right. Okay, we certainly moved into requiring an audit because we became part of a group that was large enough to require an audit, but we were audited kind of separately. And really, it did strike me that if you're smaller than a certain size, the fee is the minimum fee that they can charge is too much really for an organization that size, and it's quite difficult. Ours is quite a complex little business in terms of we sell all over the world and we're reporting under different VAT regimes in different places, and have some quite complicated revenue recognition issues with multi-year licenses and things. And so it was inevitable that they had to do a lot of work in order to do the job properly. And you ended up thinking that this can't be, that this fee is disproportionate to the turnover of the company. So I think that'll be welcomed by quite a lot of people.
Yeah, it will be welcome, although some will choose to continue to have an audit because it will give them assurance that they are doing it correctly. And especially if they are growing, they are planning to get listed or whatever, it might still be important for them to continue.
It could also be difficult if you've had an audit for several years in a row and then suddenly you don't have one. That will look then some people might not like the idea of the way that looks.
Yeah, but it's giving choice to the company and to the shareholders of the company, if you like, as to what should happen.
Great. So am I right or am I wrong in reading that small companies are going to be required to file a P&L?
You're right. So small companies will be, we still haven't got the timing on it. So they'll have to file digitally, and we haven't got the timing on that. They'll have to file their P&L. There won't be any abridged accounts. There won't be any, filleted accounts is what we would typically have called the sets of accounts without the P&L, without various of the notes. All of that is going, and that's another part of ECTA, of the Economic Crime and Corporate Transparency Act. And there was a little bit in the Act that said, well, the Secretary of State could say that we don't have to do that, that there could be exemptions, or you have to file it, but you don't have to have it available for people to see. But there's no sign at all of the Secretary of State taking up on that option. So we're virtually certain that the P&L will be filed. Well, we know that the P&L will have to be filed for small and micro companies in future. Don't quite know the date yet. We're virtually certain that P&L will be available to anybody who looks on Companies House as they do now, to increase the corporate transparency, which is, of course, the title of the Act, and to hopefully make capital allocation better, allow more information for people who are looking at limited company accounts. So generally to make the whole thing work better. It will be a big change for clients of accountants. It'll be a change for accountants filing the information, but not a terribly complicated change, because mostly, well, yes, you just file everything that you've prepared for the client. You don't miss stuff out as you would at the moment. So it'll be simpler in many ways for accountants. They might have annoyed clients that they need to placate and explain why this has to happen now.
Okay. You mentioned we talked briefly about auditors in the context of the fact that they might lose some of the smaller clients because of the changes in threshold. But what more generally about auditors? What should they be focused on or thinking is coming up this year?
Yeah, well, I think at the moment, we've got some things which have happened already, like ICAEW, the quality management standard. And I think we will get continued focus from the regulators on the root cause analysis, which is required whenever you identify a deficiency, and the annual assessment of your own system of quality management. These are, they kick in rather later than the initial requirements. So it's only now that the regulators are starting to see, are you doing a proper root cause analysis? Are you properly assessing whether your system of quality management is effective or not? So firms really need to pay some attention. They can't think, well, I did that a couple of years ago, that's it, and forget about it now. They really need to pay attention to those things. So I think that's something for auditors to watch out for. Obviously, we've got a whole load of other stuff that we've talked about in terms of the changes of when an audit is required. So some careful thinking about whether something else requires an audit other than just the size, as you say, being part of a medium-sized group, for instance, meaning that you're not eligible for audit exemption. So don't just assume, oh yeah, size, that's it. There's a whole load of other requirements. So I think those are sort of some of the things for auditors to pay attention to. ISO 600, relatively recent. Hopefully firms have already done quite a lot of work on that, but increasingly they're going to be experiencing new ISO 600 live. So are they really understanding? Are they getting it right, because regulators will be starting to look at that as it comes out of the other end in terms of file reviews.
Okay, so let's turn finally to the broad subject of IFRS. Steve's going to be talking about UK and Ireland GAAP, so maybe we should cover off IFRS. I've got a couple of items that I do know about, that I know you were interested in talking about, but I want to start with one that I actually genuinely don't know anything about, that you mentioned that you'd like me to ask you about. So I'm going to do that to start with, because I'm interested. If that's exchangeability of currencies.
Yeah, it's a little bit of a niche one, and I just thought it was quite interesting. Where you've got sometimes in the world, you have currencies which are not freely exchangeable, and we're seeing this with some of the sanctions types of things and whatever. And if you've got a currency which isn't looking exchangeable in the normal sense of, just go down wherever, swap your pounds for euros, then what they've put in place are new rules to describe what you should do in terms of your accounts in order to get figures in the accounts, because you've still got to put some sort of exchange rate into your accounts if you've got transactions in these weird currencies. So very niche, but it just piqued my interest because it goes through what to do if you end up with these difficult situations.
Okay, good. Next up here, IFRS 9 and IFRS 7. This is financial instruments, isn't it?
Yes, it is financial instruments. And again, this, well, probably not nearly as niche as the previous one, I have to say, because increasingly organizations use electronic payment systems to deal with bill payments. It all sort of happens automatically. Now, the problem is what was in the standards in terms of when you de-recognize a financial liability, when it comes off the balance sheet, and what was happening in practice were not necessarily quite matching up. And so they've said, okay, well, let's take account of how these electronic payment systems work. What happens in effect is you might have an electronic payment, it gets initiated sort of one day, and it might take 2 or 3 days to finish. And some of the accounting systems might, for instance, have de-recognized the liability as soon as it was initiated, whereas actually you haven't met the obligation until it's got to the other end. So they've got some logic as to, okay, as long as you can't just back out of it easily, you can regard, for instance, the initiation process as when that liability is de-recognized. But it's not quite as simple as that. So you'd have to look at it in detail if that is what is being used. And of course, increasingly, more and more organizations will use sort of automatic systems, not just the banks and whatever. So you might think, oh, it's just banks, and it certainly is them, but it might be quite a lot of other ones as well using electronic payment systems. So something to bear in mind.
Okay. One that everyone's getting very excited about is big news, but I know not coming all that quickly, is IFRS 18. What should we be thinking about now about that?
Yeah, so IFRS 18, the replacement for IAS 1, the presentation and disclosure standards. So the P&L, the other primary statements, what everything looks like. What they're doing is taking a bit more of a cash flow approach, not in terms of the figures that go in it, but in terms of the presentation, in that they're going to split activity between operating, investing, and finance activity. Sadly, the definitions are not necessarily exactly the same as in the cash flow statement requirements. So don't just think, oh, yes, I know all about that. That's fine. There will also be some new subtotals, so operating profit and loss loss before financing and income taxes. Slightly different subtotals for financial services sector businesses, because obviously their business runs in rather different way. So it's applicable from 1st of the 1st, 27. Bit of time to think about what you need to do in order to be able to ensure that you can gather those figures, because it might need reconfiguration of your accounting system. Often we're talking about quite big companies using IFRS, so they might have SAP or whatever and need to reconfigure things. So you need a bit of lead time in order to get ready for that.
Okay, and finally, a bit less sort of fundamental than IFRS 18, but they're nonetheless an important for some people, IFRS 19.
Well, interesting as to who it's going to be important for, because IFRS 19, subsidiaries without public accountability, is the international version of FRS 101 in the UK. So a reduced disclosure framework for subsidiaries which themselves are not publicly accountable, albeit that they might be part of a group that is publicly accountable. Now, what we're not at all sure of is whether the UK Endorsement Board which has to endorse an IFRS before it is applicable in the UK, will actually endorse IFRS 19 at all. So mostly I wanted to mention IFRS 19 to remind people that used to be the EU EFRAG that endorsed things because we were part of the European system. And now, of course, we have the UK Endorsement Board, which endorses or not a standard for use in the UK. So always check with a new standard, has the UK EB endorsed the standard? What is the timing of that endorsement? Because it could be different, even if ultimately they're going to endorse it. They may not endorse IFRS 19. We don't know.
Well, what's the timescale on that? Do we know when we'll find out?
There's a lot of information on the website. I can't remember off the top of my head. I don't think there was a specific timetable timing for it, but there are agendas and there are work programs. So you can always look on the UK EB website, just Google UK EB, it comes up easily enough, and look at the particular projects and it'll give you the timeline for that particular project. We should know well in advance because again, it's 2027 that is the normal sort of implementation date internationally for that. So we should know well in advance, or at least have an idea as to whether they're thinking that they will or won't endorse it. But it's not got the same applicability in the UK because we've already got FRS 101. It's not the same as FRS 101 in terms of what it allows or doesn't allow. A lot of people may prefer FRS 101. So there'll be a bit of a big debate, I think, on that.
Great. Okay, well, thank you very much. I'm going to have to bring this section of the webinar to a close, or we'll run out of time.
We will.
So for now, I'll say thank you very much, Julia. Interesting and fascinating as always. We'll see you again later on when we'll welcome back everyone to answer questions.
Thank you, Alan. See you later.
So now I should introduce our next guest, Steve Collings. Steve Collings is a director at Levitt Walmsley Associates. A fellow of ACCA, Steve's an internationally recognised speaker, writer and commentator on all matters to do with financial reporting and auditing. He's the recipient of numerous awards, including being named as Accounting Technician of the Year and being recognised for his outstanding contribution to the accountancy profession, sorry. I once got told off by an author for getting that wrong. Steve sat on the UK and Ireland GAAP Technical Advisory Group at the UK's Financial Reporting Council for 5 years and has represented the accountancy profession in the Parliamentary Review. He's a frequent guest on these webinars and is the author of our popular UK GAAP Updates and Auditing Updates courses. He's also written on a range of topics, courses on auditing and financial reporting. This year, he'll be writing new courses on the periodic review, which we're going to be talking about today, and on acting for small and micro entities. Hello, Steve.
Wow, that's a lot, isn't it?
You are a lot, Steve.
I do have a life, outside of all this. I'm not constantly, with a head in an accounting standards, but my life's not quite that tragic yet. But
I do wonder whether I do believe you have another life, but I think maybe this one seeps into it.
Yeah.
So we're here to talk about the periodic review. The two main changes seem to be really about incorporating things that have been in IFRS for a while into the UK and Ireland standards. Can I start with what I think of as IFRS 16 on leases and how that's being adopted?
Yeah, so the way that the FRC sort of think when they're developing these standards now is obviously an IFRS approach. That's the way that UK and Ireland GAAP is sort of going nowadays. And it's something that has been established now for a long time since the introduction of FRS 102. So unsurprisingly, the FRC have, of course, scrapped extant section 20 in FRS 102 and gone back to the drawing board and given us a brand new section 20 in FRS 102 September 2024, which is, of course, new lease accounting requirements for lessees. And it is wrong to say that it is aligned to IFRS 16, in my view. I have been shot down in flames by a couple of people, but I think it's wrong to say it's aligned to IFRS 16 because that immediately implies that the FRC have literally took IFRS 16, copied and pasted it into Section 20, and that's not the case, because IFRS 16 is, of course, an incredibly complicated standard, and the FRC's principle is that their accounting standards have got to be proportionate and cost effective to apply. So we've got what I call a simplified version of IFRS 16 in Section 20 of FRS 102. It is just worth mentioning, before I go into some of the technicalities of it all, that this does not affect FRS 105. Okay, so under FRS 105, micro entities will just carry on as they do now, you know, so there's no sort of major change in FRS 105 where leasing is concerned. But for FRS 102 reporters, this is quite significant because for lessees, there is no distinction anymore when you apply the new lease accounting requirements. There's no distinction between a finance and an operating lease. A lease is a lease is a lease. Okay. So what the upshot of that is that most, and I do emphasize the word most here, most leases will go on balance sheet, and this will have a consequential impact when it comes to initial application of this periodic review amendment, because while we don't have to restate prior year comparatives, we do have to do what I call like a cumulative catch-up to bring what was an operating lease onto the balance sheet the first day of the accounting period in which you first apply the periodic review amendments. So in the year of initial application, there's going to be a bit of work involved, depending on how many clients you've got that have got operating leases that need to be moved on balance sheet. Of course, I'm going to be covering the technical accounting treatments in the course that I'll be producing this year. But like I said, the main thing is that most leases will be recognised on balance sheet. There are two exceptions. The first one is, I'm going to start with the easy one first. The first one is a short-term lease. Okay, now a short-term lease is one where the lease term is 12 months or less at the date of commencement of the lease. So be careful to interpret that correctly. So don't think that at the balance sheet date, if you've got a 3-year lease that's only got 9 months left at the balance sheet date, you can just bring it off the balance sheet and treat it as what was an operating lease, because that's not how you do it. It's got to have 12 months or less to run. If there's an option to purchase in the lease as well, that isn't going to satisfy the short-term requirements. So if you have got a lease that is short-term, then you can treat it in pretty much the same way that you would treat an existing operating lease. The other exemption relates to low value assets, and this is where the fun and games are going to start, I think. Because I think it's I'm going to smile. Rachel, I know Rachel's not on camera at the moment, but she's going to smile when I say this, because paragraph 100 in the basis for conclusions of IFRS 16 does mention a value, a monetary value that the IASB had in mind when they were developing IFRS 16 for what they considered to be low value. And that figure was $5,000. Now, in contrast, the FRC were quite adamant that they were not going to quantify in any way, shape or form a value for low value, what they would consider to be low value. So what they've done instead is they have provided a list of assets that the standard would not consider to be low value. So things like cars, vans, buses, land and buildings. Basically, if you can climb into it or it's got an engine, then it's not going to be low value. And the idea behind this list is that when you are considering whether an asset is of low value or not, you've got to judge it in terms of whether it would be similar to something in that list. So we forget materiality, because materiality doesn't really come into it. And the underlying value of the asset is not based on the lease payments either. It's based on, it's an absolute basis. So we need to be careful with how we're valuing this. It is something that's left quite a lot of us scratching our heads in terms of how this is going to be applied practically in terms of the low value. There is material being developed by the professional bodies, because obviously it's the professional body's job to interpret the standards. It's not the FRC's job to interpret their own standards, but it's a professional body's job. So there will be material being produced. I know ACCA have published a technical fact sheet on lease accounting. It's also just worth noting as well that the FRC have published an FRC fact sheet on the new lease accounting requirements as well. That is free of charge from their website. So have a look at that as well. But it is going to, in the year of initial application of these new lease accounting requirements, I can see it being a bit of a bumpy ride. I've got a client that's in the haulage industry, and they have got 75 operating leases at the moment. And I've convinced them to early adopt the standard. So I'm going to, get them through the pain of initial application earlier, because you can early adopt the periodic review amendments, but you've got to adopt them all. You can't. It's not just well, we like that bit, so we'll use that and we'll ignore the rest. You can't do that. It's an all or nothing approach. But lease accounting is, of course, the what I call the biggie at the moment. It's certainly taken the headline. But I mean, we don't rank these in terms of importance. All the periodic review amendments are important.
Are there any issues people should look out for in terms of lots of small leases adding up to one big lease? I'm thinking particularly of people, an organisation perhaps might come to an arrangement to have all of its PCs and printers supplied. Yeah. And each individual laptop might be a small lease, but the whole thing is quite a big arrangement.
So you do it like on an individual sort of basis. So we're still looking into that, because there are different opinions where that is concerned at the moment in terms of that, because I know for sort of capitalization purposes, so I'm moving out of section 20 now and I'm going into section 17. You would sort of capitalize the whole lot, because I mean, it may be below the entity's capitalization threshold, but you're still using the asset for more than one accounting period, and collectively they all do the same thing, so you would recognize it on the balance sheet. My initial instinct would be that the standard does talk about low value assets. So we're looking at them sort of individually, really. But again, we're sort of scratching our heads on that, because I know a couple of us at ACCA sort of do have different views on it at the moment. So that is something that these sort of like little anomalies will eventually sort of like get ironed out, and we'll get on a smooth path
Good.
as soon as we can.
Great. I know you don't like me talking about it as though it's an IFRS, but I'm going to carry on doing that. Next one up is IFRS 15 on revenue recognition. Now, what I do know about the revenue recognition standard is that it's quite a specific and detailed set of requirements. How are they going to make that work for smaller companies?
So you are right to refer to it as IFRS 15, because I mean, again, what they've done here, and this affects both FRS 102 and FRS 105. So they've gone back to the drawing board again, and they've completely scrapped section 23 in 102 and section 18 in 105 and redrafted these specific sections. And what we've got now in both sections, or what should I say, what we will have, unless you early adopt the periodic review amendments, is this comprehensive 5-step model approach to revenue recognition. So the idea of this is that an entity will recognise the correct amount of revenue at an appropriate time using this comprehensive 5-step model approach. Now, when you look at it in detail, which I've done, I don't know how many times, steps 1 to 4 in the 5-step model approach, I would say that pretty much most businesses do know. There is this sort of, certainly in practice, that you apply steps 1 to 4 already. There shouldn't be any major shocks in it. I think the standard's just being very explicit in how we recognise in revenue. It's step 5, the actual revenue recognition step, that I think is going to cause a few head-scratching moments for some entities, because we have got specific requirements now for things like upfront payments and royalty and licensing sort of revenues. So there are going to be some entities that are really going to have to look at their accounting policy for revenue to make sure that it does actually fit the new requirements. What I'm not expecting is huge swathes of companies having to completely change their revenue recognition policies. Because, I mean, whilst I've always said that the current Section 23, the current Section 18 in 102 and 105, whilst they are, well, they're certainly better than what we had in old UK GAAP, because we didn't have any accounting standard under old UK GAAP for the biggest number in the accounts. We had UITF 40, but that was a bit of a bone of contention. So currently, I would say that it's better than what we had, but it's still a clumsy set of principles in Section 23 and Section 18, whereas this new version that we're getting, it is going to require entities to seriously consider what their accounting policy is, because of course we're going to have to sort of make additional disclosures as well in the financial statements under Section 23 of 102. There's going to be more in the way of disclosure, which you would expect with a more comprehensive revenue recognition section. But I think initially we need to start getting companies to think about their sort of revenue recognition policy, particularly where you have got these sort of unusual revenue characteristics. Like you say, in accounting CPD, you've got sort of multi-year licenses, and you might have sort of gym memberships and stuff like that, which might look quite simple to deal with, but in substance, they can be quite fiddly in terms of getting the revenue recognition correct.
My concern with that is for when it's applied to small businesses is the kind of amount of accounting work that can end up having to be done in order to implement it. So yeah, you mentioned that we have multi-year licenses, but actually we frequently do promotions where we say buy now and get a couple of months extra free, and suddenly we're kind of going, oh, so we're selling 14 months, not 12 months. We'll have to recognise that differently to the 12-month one, and then if you're not careful, you end up with the accounting treatment controlling the promotional campaign, which seems like the tail wagging the dog. But if you end up spending 3 days at the end of the month working out what the hell the revenue is, that's not right either. So getting it right so it's proportionate to the impact it's going to have seems important to me.
I think the FRC have managed to do that, because if you look in sort of one of the appendices to FRS 102, you'll see sort of their principles that they follow in setting standards. And not only do they have to be sort of consistent, which is why we're not going to see these periodic reviews being done every year, more or less like every 5 years, but they've also got to the cost benefit has got to be rightly balanced as well. So, you know, smaller entities, which is why FRS 102 Section 23 is nowhere near as complex as IFRS 15, because that would mean that the FRC aren't setting standards in accordance with their own principles, which goes against the grain. So the FRC would always make sure that in standard setting settings that they're complying with their own principles. So there will be sort of, I imagine, and Julia will probably agree with me on this, that whenever there is a new standard, whether it's an accounting standard, auditing standard, or whatever, there's, you know, in the first year of application, it might be hit and miss in a lot of cases. And it's then a case of learning from the mistakes and getting things on a more smoother path, which is another reason why the FRC have given us so long in terms of implementation time, because these periodic review amendments, of course, don't kick in until December 2026 year ends, but you might want to early adopt, as I've done for one of my clients. And it's about making sure that we as preparers fully understand the accounting treatments and the impact of these new changes on clients' financial statements. Because from a commercial perspective, there could be things like debt covenants that could well be breached. You know, you're bringing in additional assets and liabilities when you're capitalising the right of use assets under Section 20. That could breach any sort of debt covenants that might be kicking around loan agreements and stuff like that. A lot of people were concerned about the impact of audit exemption because, of course, one of the audit exemption criteria is the gross assets test. Well, as Julia mentioned, these company size increases, the thresholds are increasing. So that should sort of give some buffer against many companies falling into audit. But it's all these practical aspects that you've got to consider rather than just the debits and the credits.
Good. Okay, that all makes sense. And we'll see how it plays out in practice, I guess, and evolves over time.
Yeah.
Can we turn finally to small company disclosure requirements?
Yes.
What's going on there?
Dividing the audience here because I'm going to mention that swear word Brexit that does seem to, you know, drive a lot of people's blood pressure. You know, if you look at the social media, it's still a very divisive subject. But Brexit, believe it or not, does have an impact on financial statement disclosures for small entities. And some people can be forgiven for thinking, what on earth am I talking about? Am I just being controversial here? Well, no, I'm not, because pre-Brexit, we, of course, were subject to the EU accounting rules, and the EU accounting directive was brought in back in 2015. And what that did was that set the boundaries for small company disclosures. And the EU accounting directive was quite a powerful directive in that it restricts member states, the regulators of member states, from straying beyond the margins of the directive. So in other words, the FRC were constrained by the disclosure requirements of the directive. So it may have been the case that, for example, the FRC took the view that going concern disclosures should have been mandatory, but they weren't in the EU accounting directive. So the fact that the FRC might think something should be mandatory was basically irrelevant. You know, the EU was saying, no, you can't do it. Well, of course, now we've left the EU, the FRC are now free to mandate additional disclosures for small entities, and that is exactly what they have done. So Appendix C in the September 2024 edition of FRS 102 contains additional disclosure requirements. Now, you might know about Appendix E, which is the encouraged disclosures section in FRS 102. And that's the FRC's way of trying to sort of say, look, these are the additional encouraged disclosures that we think you might need to put in your financial statements to achieve a true and fair view. So what the FRC have done is they've moved all the encouraged disclosures into Appendix C, so they become mandatory for sort of December 2026 year ends onwards, and they've included additional disclosures in respect to leasing, as you would expect, because of the new lease accounting rules, revenue recognition, current and deferred tax is in there. And they've also extended the related party disclosure requirements for small entities in the UK. So effectively, a small company will be disclosing full related party disclosures again, rather than just the limited related party transactions that have been concluded under normal market conditions, as is the case at the moment. So quite a bit more in terms of disclosure requirements for small entities, less so for micros, because of course micro entities are still subject to the micro entities legislation, so there would have to be a change in company law to sort of do that. And plus you've got the deeming provisions in the micro entities legislation as well, which automatically means the financial statements give a true and fair view if they've been prepared in accordance with FRS 105. So small companies are going to be making more in terms of ways of disclosure. So Appendix E in FRS 102 September 2024, which is of course the encouraged disclosures, will then only be relevant to small entities in the Republic of Ireland, because of course the Republic of Ireland is still in the EU and hence is still subject to the directive.
Yes, of course. I hadn't thought about that divergence. That's inevitable, isn't it? Okay, good. Right, well, we could carry on talking about this for ages, Steve, but we're going to run out of time, and I'm going to use up the time we were going to spend talking to Rachel. She'll never forgive me.
Oh.
So we should bring this part of the webinar to a close. I should say thank you. That was great. I need you to stick around and answer people's questions at the end. And so we'll see you in a few minutes, if that's okay.
Yeah.
So now I'm delighted to welcome Accounting CPD's Rachel Bruce, who's going to share some of the things we've learned from you this month. Rachel's our publisher. She handles all of our relationships with authors and subject matter experts and the programme of topics we cover. Hi, Rachel.
Hello, Alan.
Can I start with today's topic? It's a bit of an amorphous topic, but we are looking at the year ahead. I know we've published a couple of thought pieces on this from other authors. Am I right that Wayne Bartlett wrote one on how the UK Chancellor might approach 2025?
Yes, we did. Obviously, Wayne, like our other two authors on today, a good friend of Accounting CPD. And he wrote a bite called A Challenging Fiscal Year Looms. So obviously, that's what he's been writing about. And he looks at how the Chancellor might approach 2025 and how it might impact your business. So before we got into the meat of the bite, we asked, how optimistic do you feel about your business compared to how you felt at the start of 2024? 3% said much more optimistic, 9% said more optimistic, 41% said they felt about the same, 35% said less optimistic, and 10% felt much less optimistic. So it looks like people are expecting a difficult year ahead. And as the bite says, an index from the trade group Make UK shows that manufacturers' confidence in the UK economy fell at the sharpest quarter-on-quarter rate since the pandemic in the final 3 months of 2024. In the bite, Wayne provides us with a take on the economy and the Chancellor's position. So for Wayne, Rachel Reeves seems to be up to an impossible task, and he says, recent economic growth figures do not make welcome reading. Growth effectively flatlined in the third quarter of 2024, and there are some fears that we may not be far off a recession. Even if that does not happen, there is a strong possibility that any growth that might transpire will be very low. It's not good reading, but how did this happen? So Wayne mentions that it might be to do with the raising on national insurance, which created a lot of pushback from employers, and not just in the private sector, but the charity and public sectors too. It's potentially the cause of the fastest fall in employment for 3 years, with a drop in the S&P Global Flash Purchasing Managers Employment Index from 48.9 in November 2024 to 45.8 in December. So to sum up, Wayne leaves us with this line: there is a clear need to try and improve links between the still fairly new government and business in 2025, if prospects for growth are to strengthen. In terms of New Year's resolutions, this should probably be high up on the Chancellor's list. So at the end of the bite, we asked you, what could the Chancellor do to get business back on her side for 2025? And so just to share some comments. So one of our learners said, we are in a difficult financial climate, so tough and unpopular decisions will need to be made. The Chancellor needs to somehow encourage growth and investment. So that certainly seems to be a message the Labour Party do want to send at the moment. Somebody else said, looking at closing tax loopholes for online retailers and those registered offshore would be good. If you want access to the UK marketplace, you should pay tax accordingly. So an ongoing source of debate there. And somebody else said, help smaller businesses. The NI increase is going to be difficult to cover. And also business rates are really high for anyone trying to start up. And there are a lot of people on this bite actually talking about the pressure on small businesses. So interesting bite. So go and have a look if you want to see about what Wayne's saying about what Rachel Reeves has been kind of up to.
Great. Turning to a topic that seems to be at the top of everyone's agenda right now, and that's artificial intelligence. I mentioned at the start that Julie has written what's proving to be a very popular course on AI and ethics. What are people making of that? Please say they like it. It would be unfortunate if you don't say that.
Well, it would. Yes, no, it has proved very popular. And I think the combination of the two things and having Julia specifically writing about those has been great. So in this particular course, Julia looks at how AI is transforming how accountants and finance professionals work, and she offers some unprecedented efficiency and insight into this. And she considers that with the advancements comes significant ethical challenges, and they demand careful consideration. And Julia looks at how, as accountants, we need to ensure that AI operates fairly, transparently, and in alignment with professional standards. So early on in the course, Julia looks at why AI and ethics matters. And she asked our learner community to consider each of the ethical principles of integrity, objectivity, professional competence and due care, confidentiality and professional behaviour. So Julia asked the question, which of these concepts do you think are relevant to AI and why? So just sharing some of your answers as usual. So most people are obviously saying they're all relevant in some way. The first person said all of them. Integrity, being honest and transparent about the use of AI. Objectivity, not trusting AI blindly, but doing a sense check on what it comes up with. Professional competence and due care, using one's own training and judgment to assess AI output. Confidentiality, so respecting how data you do not own is used by AI. And professional behaviour, respecting laws and regulations, not bringing the profession into disrepute. Another learner said, all are relevant. These are more than concepts. These are values I hold dear as an accountant and should apply to AI. Someone else said, particularly objectivity and professional due care, as AI can't apply judgment in respect to a specific situation. Someone else said, they all have relevance to AI. Integrity, the accountant needs to be clear and open, which includes determining whether the disclosure of the use of AI is necessary. Objectivity, whether conclusions reached have included AI output and how much reliance can be placed on that output. Professional competence, and whether the use of AI has been done competently and with due care. Confidentiality, by using an external AI system, how likely has client data been maintained in a secure fashion? Professional, in that the accountant has behaved in a professional manner in the decision to use and in the use of AI. The final comment I've got here, all 5 of the concepts are relevant to AI. If any one of the 5 is overlooked, there is the potential for abuse of AI. There are honestly so many answers to this question in this course. This is literally a small handful in very many. And in the other modules in the course, there are further questions, and there's some really good discussion actually about how you're using AI already as accountants and for what you're using it for, and the ethical considerations required. So it's definitely really worth having a look at this course, and yeah, it's really prompting some good discussion as well as all the other content that's in there too.
Sounds like that's really prompting some serious reflective thinking,
really is, yeah.
Which is really encouraging to see, and I guess is what CPD is supposed to be about. So that's
yeah,
great.
Absolutely.
Okay, I should bring back Julia and Steve, because we're coming to the end of our time, and people will have questions for them. So I'll say thank you, Rachel. That was a pleasure. Stay where you are, and I'll welcome back Julia and Steve so that I can put some of those questions to them. Hello, Julia. Oh, hello, Steve, as well.
Hello again.
Steve was busy looking at paragraph numbers.
Yeah, I'm going to point this question at Julia first, although it screams Steve as a question, but I think if I ask Julia first, then Steve will always have something to add. How well, Steve did talk about this a little bit while it was there, but the question that's come in is, how well are the FRC doing in making the standards proportionate to the needs of small business?
Oh, that's a great question. It depends on your point of view. I think some people will always think that what the FRC are requiring is too much, it's too technical, it's too difficult, and you'll always get a backlash from some. But I mean, personally, I'm inclined to think that, if you're going to do something, then let's do it well. And having things like the principles, the 5-step approach on revenue recognition, which says, okay, think through these principal points, gives us a much better framework for recognizing revenue. And it means that we can cope with all sorts of different situations, all sorts of different revenue types, which is what we get in the modern world. So I think they're doing not a bad job. Sometimes you think, well, just think a little bit more about smaller companies. But most of the time, I think they're getting there. That, in my opinion, they've made improvements in this area over the years.
Right. Steve, do you agree?
Yeah, I think I do sort of agree to a certain extent, and I get where people can get frustrated at the accounting standards, because I'm not being funny. FRS 102 is not a Harry Potter read, is it? I mean, I don't read Harry Potter, but it's a famous book. But I mean, the FRC are trying, and they've got to do things from a high level approach to try and capture all sectors and all industries, which in itself is a bit of a mountain to climb. But also as well, don't forget, they are trying the best within certain limits from their protocol that they are, their remit. I mean, they've issued staff the FRC fact sheets as they're called now. So, you know, they are there from a very high perspective, but, you know, they have got the hands tied into how much they can actually do in terms of interpreting their own standards, which of course is the job of the professional bodies.
Good. It's really a difficult job, isn't it? Because when you introduce any kind of new standard or requirement, people don't want them to be very, very prescriptive about it. And so it involves people doing a bit of work thinking about how they can apply it to their particular company. And in the process of doing that, which is often initially a bit tortuous and frustrating, people throw their hands up and say, oh, this is ridiculous and disproportionate. And then maybe 18 months later, they think, oh, actually, this is okay.
Yeah.
So I think sometimes those criticisms come up along the way, and we don't hear, nobody chimes up and says, do you know what, this is going all right now, because that's not a very interesting thing to say. But I think we can never react to it.
It must be said.
Good. Well, it's 1:39. Sorry, 1:59. So I should bring things to a conclusion. It remains for me to say thank you very much to our panelists. Thank you, Julia, for your thoughts and insights about ECCTA and other changes, and Steve for sharing with us your observations on the periodic review. Thank you, Rachel, for sharing what we've learned from the accounting CPD community this month. But most importantly, thank you all for coming. I have 2 dates for your diaries. Our next Lunch and Learn webinar is at 1 p.m. on the 26th of February, when we'll take a further look at financial reporting. Steve will be back, and we have Wayne Bartlett joining us as well. Before that, on Thursday, the 20th of February, at the earlier time of 11 a.m., Anna Faherty will be exploring how accountants can improve their communication skills. We'll hope to see you at one or both of those. Till then, goodbye.